Hi everybody, welcome to another video of what's moving the markets. Today we're going to talk about the shocking red hot January jobs report. Now this report comes out on the first Friday of every month. So the report for January has come out on the 4th of February. So that is just 2 days ago. And when the market opens on Monday, we expect to see that investors and traders will have incorporated this report in their actions. We actually saw the impact on Friday only, but the impact is going to be large because this report is shocking. And when I say shocking, what I mean is that it is very different than what the investors were hoping for. And it's tricky because it's a good jobs report. It's a red hot jobs report, which means it is so good. It is so good that it's completely opposite of what the investors were hoping for. And why the investors were hoping for a bad job report is because if the jobs report would have been bad, then the Federal Reserve would have continued to support the economy with expansionary monetary policy, which means increasing money supply and low interest rates. But that is not what has happened. Before we move on, just as usual, a small disclaimer that this is not investment advice. It's a casual video series. So please do your own due diligence before taking investment decisions. Now, moving forward. So the US Bureau of Labor Statistics released the January 2022 jobs report day before yesterday. So by the time you see this video and then before the market opens on Monday, it would be 2 days that would have passed since the release of this video. It came out on Friday, the 4th of February, and it is shocking, red hot, right? Now, what does that mean? That means that non-farm payrolls, which is those jobs which are not related to the agricultural sector, they surged by 467,000. And why is it shocking? Why is it red hot? Because the forecasted number was 125,000. Now, just to tell you where this number of 125,000 comes from. So there are very prestigious institutions like Bloomberg that do surveys of leading economists and investment managers, and then they take an average. So that's where this number is coming from. So it's not like a random number that someone was expecting. This is a number that the leading economists and investment managers were expecting. And this is their average, right? It's not even an outlier or anything like that. And the result is completely different. I mean, just look at the difference. You've got 467,000 versus 125,000. So this is a massive, massive surprise. Now, it's excellent for the economy, but it's very bad for the markets. And we're going to talk about that today. So why is this important? It's important because the Federal Reserve has a double mandate. And for those of us who don't know what that is, we're going to talk about what is the double mandate of the Federal Reserve in today's video, right? Just briefly, it is controlling inflation and ensuring full employment. But we'll talk more about that in detail in the next slide. And in the past few videos, we've been talking about only one part of this mandate, which is inflation, right? That inflation is going up and Federal Reserve has to control it. The other part of the Federal Reserve's mandate is ensuring full employment. And that's where this job report is going to come in, right? And we will talk about how that is going to impact the Federal Reserve's mandate and what that means, what this job report means for the markets. So first of all, we will be talking about the double mandate of the Federal Reserve. Then we're going to cover what economists are saying about this red hot jobs report. Then we will link the two, that what this strong job report means for the March rate hike, and not just the March meeting of the Federal Reserve, but the rest of the year as well. So what we're expecting and what this job report means for the rest of the year of the Federal Reserve monetary policy stance. And then, of course, as always, we will talk about how this is expected to impact the market and what we could do and what the other investors are expected to do in this current situation. So moving on, let's talk about the double mandate of the Federal Reserve. Now, the Federal Reserve has a dual mandate in which the first part of their monetary policy goal is to ensure stable prices. And that is a core inflation of 2%, right? The second part of their mandate is to ensure maximum sustainable employment. And if I were to put that in quantitative terms, that means approximately 4.1% unemployment. So not more than 4.1% people should be unemployed, and the prices should not be rising more than 2% year on year. And when I say core inflation, so the target here is for core inflation, which is non-energy, non-food, non-energy. And why is that? Because food prices are, of course, volatile due to there might be a famine, a crop might get spoiled, weather issues, right? Energy prices are also volatile, especially because it's an oligopolistic market, especially for oil. And, there are a few big suppliers, and due to political issues, sometimes the supply increases or decreases, and that really impacts the prices. So the Federal Reserve has a mandate of core inflation, which is the inflation after taking out the impact of food and energy, right? So this is non-food, non-energy inflation, and that is supposed to be at 2%. And the economy is supposed to have not more than 4.1% unemployment. Now let's move on to the job report. So this January's red hot job report, number one, the payroll surged by 467,000, right, compared to an expectation of 125,000. So naturally, that is a very, very good report in terms of unemployment going down. And unemployment is currently at 4%. So as we discussed in the previous slide, that the Federal Reserve wants it to be below 4.1, and it is, right? So this is good. Even though it was 3.9 before the pandemic, so it's not as low as where we were before COVID-19 hit, but it is still lower than what the target of the Federal Reserve is. And the labor force participation is going up, right? It has come up to 62.2%, which again is the highest since COVID hit, which is March 2020, even though COVID started in December 2019. But the impact that we have seen in the financial markets was primarily there in March 2020. So that's when the markets crashed as well. And another indicator is what we call the hourly wages, the average hourly wages, and this has also come up 5.7%. So that is an unexpected jump. It's a big jump, right? And this is also the biggest since May 2020. So this is overall a very, very good jobs report. I mean, from an economic perspective, the US economy is doing well, right? So this is a red hot jobs report. But why is that bad for the markets? So now let's link the two, the dual mandate of the Federal Reserve and this jobs report. So because after this report, the job market looks strong, right? and it is close to what the Federal Reserve would define as maximum employment, which is an unemployment of less than 4.1. So therefore, the half part of the dual mandate of the Federal Reserve, which is maximum sustainable employment, is achieved, right? And the other part, which is core inflation at 2%, this is not achieved. And we've discussed this in the past few videos, that what's going on with inflation. If you guys have watched the previous videos, you would know, and you would otherwise also know if you're following inflation, that December 2020 to December 2021, CPI, which is the Consumer Price Index, it rose 7%. And even if you take out the impact of food and energy, right? So if you just take core inflation, so even core inflation is 5.5%, right? It's up 5.5% from December 2020 to December 2021, which is obviously much greater than the 2% target of the Federal Reserve. So now put yourself in the shoes of the Fed, and on one side they've got the unemployment situation under control, but on the other hand the inflation is clearly not under control. Now what happens is that if the Federal Reserve goes on to try and control inflation by increasing interest rates and by reducing money supply, and the economy kind of slows down, that's usually bad for the economy and for the jobs. And the Fed wouldn't do that if the economy was not in good shape, if the job market didn't look so strong. So it's a trade-off, right? It's always a trade-off for the central bank, that on one hand they've got inflation, and on the other hand it's got the unemployment situation. And if it tries to control inflation, the unemployment increases. If they try to control the unemployment, the inflation increases. So you have to be able to afford to do both, right? And currently, because the job market looks so strong, the Fed can afford to increase interest rates. They can afford to go for a contractionary monetary policy to control inflation, because the unemployment situation is low and the new jobs are being created much more than expectation, right? So this jobs report is expected to further fuel expectations that the Federal Reserve is going to likely raise rates 6 times this year. So the market is expecting 6 rate hikes starting as early as March, which is just around the corner. One more thing which is just around the corner is the data on economic growth of the first quarter, right? And if this is not good, if the economy shows that it is not growing, or even if it is growing, it's growing at a slower rate compared to what we've been seeing, then the Federal Reserve might kind of just, take a step back and say, okay, let's not increase interest rates so much so fast, and let's not cut down the money supply so much so fast, because we don't want the economy to slow down and we don't want the unemployment to go above 4.1. So that could be a showstopper. But currently, the way things are going, the economy has been growing, the jobs report is fantastic, and inflation is definitely much above the target, right? So status quo is that we can expect up to 6 rate hikes this year, starting from the March meeting, which is next month. So what does all this mean, right? How is it going to impact the markets? Well, it's definitely a welcome sign for the economy, but not good for the markets, because the investors were hoping for a bad job report so that the Federal Reserve doesn't increase interest rates and reduce money supply very, very aggressively. But this increase in payrolls, it's going to give the Fed the room it needs to actually pull back inflation. And we saw an immediate impact in the market on Friday once the job report came out, right? It was a decline in the S&P futures, and which is obviously a confirmation that the interest rate hike is imminent, which is a necessary move by the Federal Reserve to dampen the trajectory of inflation. So that is going to happen, and if it will happen, obviously the borrowing costs will go up, and people are going to flight to safe havens or safe assets. And I mean, you could talk about gold. I personally don't think that gold is a good situation to be in, a good asset to be in, because if interest rates are going to go up, right, and I could put my money in bonds, right, which are paying the higher interest rates, then why would I want to go for gold? So bonds should be in demand, but not before they come down in prices. So, I mean, I would probably go for something called TIPS, which is Treasury protected, inflation protected securities, right? So these are the inflation protected securities. So their demand definitely is probably already going up, and that is what we mean by safety assets. Now, you can also increase your portfolio percentage for risk assets, which are supposed to be a good hedge against inflation. And here we can talk about agricultural commodities and industrial metals. And if you watch our last week's video, we've actually made a video on this, that how you can easily and efficiently invest in these commodities and metals through ETFs. And when I say efficiently, obviously I mean low cost. So these ETFs, they have tickers just like stocks. So it's like as easy as buying a stock. You just have to go and buy the stock for that ETF, right? And we've also talked about in the video the week before the last one about high quality value stocks. And in that video, we talked about companies that have the ability, the luxury to pass on these higher prices to their customers because they have these wonderful brands and this fantastic proprietary technology that their customers love, and they will be willing to buy their products even at higher prices. So their revenue will increase, which means their top line will increase, their net profit will increase, their bottom line will increase, and their earnings per share will increase, and that is good for you as investors. So in the current situation, yes, we've been talking about inflation for the past few videos, and now we've also put things in context with regards to unemployment, because the Fed does have a dual mandate. And this month's January's job report, which has just come out day before yesterday, just confirms our current situation, that not only does the Fed need to increase interest rates and reduce money supply to control inflation, we also know now that the Fed can afford to do that because the economy is doing so well, right? So they have room to actually pull back inflation. Now, one more asset class that I would like to talk about today in the current situation, in addition to the ones that I've already talked about, which is high quality value stocks, agricultural commodities, and industrial metals. So one more asset class that I would like to talk about is value stocks in frontier markets. Now, this deserves a whole separate video. So maybe next week we will have a video for you on value stocks in frontier markets, right? How to go about doing research in frontier markets, identifying which markets are at a low PE. So when I say trading at a discount, I mean at low price to earnings, right? So how to find them out, and then within those markets, how to hunt for good quality value stocks. So hopefully next week we should have an update for you on that. And that is definitely one of the areas you could look to add to your portfolio, in addition to high quality value stocks within the US equities and agricultural commodities and industrial metals. So that is it for today. As always, happy investing and hope to see you in the next video. Take care, guys.